Have you ever wondered how the United States became an economic powerhouse? Let's embark on a journey starting from the colonial era. Before the arrival of European colonists, indigenous communities thrived with diverse economic lifestyles, from agrarian societies to those based on hunting and gathering. As colonies were established, the economy faced a labor scarcity, but was enriched by abundant land and natural resources. The colonists worked the land, trading goods like tobacco and fur. Over time, the colonies developed a robust economy, driven by agriculture, trade, and small-scale manufacturing. In fact, just before the American Revolution in 1776, the 13 colonies had developed an economy that was about 30% the size of Britain's. This was a considerable feat considering the 12-fold increase in output from 1700 to 1774. By 1776, the colonies had created an economy that was about 30% the size of Britain's, marking the beginning of a remarkable economic journey. Following independence, the United States entered a period of rapid growth and expansion. A surge in population growth fueled this economic momentum. People flocked to America, drawn by the promise of prosperity and the lure of boundless opportunities. With this influx of people came an increase in trade. The U.S. began to establish itself as a significant player on the international stage, trading goods with Africa, Asia, and Europe. This burgeoning trade, combined with a growing population, led to an economic boom. But the real game-changer was the westward expansion. The Louisiana Purchase in particular was a pivotal moment. This historic land acquisition, which nearly doubled the size of the United States, unlocked vast natural resources and fertile lands. It spurred economic development and set the stage for the Industrial Revolution that was to follow. The stage was set for an economic transformation that would change the world. The mid-19th century heralded a new era marked by industrialization, urbanization, and the expansion of the railroad system. This period, often referred to as the Gilded Age, was a time of rapid economic growth and significant technological advancements. The United States was transforming from an agrarian society into an industrial powerhouse. Cities began to sprawl, and the railroad system expanded, connecting the vast expanse of the nation like never before. This period of great expansion and prosperity was gilded or coated in gold. The Gilded Age was also a time of immense wealth, but it was concentrated in the hands of a few. Industrialists such as John D. Rockefeller and Andrew Carnegie amassed fortunes that were unheard of. They built industries that would shape the future of the United States and the world. However, this wealth was not evenly distributed. Many workers labored under harsh conditions for meager wages. This disparity in wealth and the harsh working conditions sparked a wave of labor strikes and social unrest. The Haymarket Affair and the Pullman Strike are notable examples of worker protests during this period. These social tensions highlighted the underlying issues of the Gilded Age: wealth inequality, labor rights, and the social impact of rapid industrialization. In response to these challenges, the early 20th century saw the advent of the Progressive Era. This was a time of social activism and political reform aimed at addressing the issues that had arisen during the Gilded Age. Reforms focused on a wide range of issues including labor rights, public health, women's suffrage, and government corruption. These reforms played a pivotal role in shaping the modern United States and laid the groundwork for the social policies of the 20th century. Despite the challenges, the United States forged ahead, setting the stage for further economic growth. The lessons learned during the Gilded Age and the Progressive Era continue to reverberate through the annals of American economic history, reminding us of the nation's ability to adapt, innovate, and overcome. The 20th century brought with it the Great Depression and World War II, both of which had significant impacts on the U.S. economy. The Great Depression, a period of unprecedented economic hardship, began in the 1930s. The stock market crash of 1929 triggered this economic downturn, causing widespread unemployment and poverty. It was a time of struggle, when the American dream seemed more like a distant memory than a possible reality. However, the narrative took a turn as World War II broke out. This global conflict became an unexpected catalyst for economic recovery. The U.S., though initially neutral, was supplying arms and other goods to the Allies, which led to an increase in production and employment. The war effort mobilized the American economy, sparking innovation and pushing industries to their full potential. As the nation emerged from the shadows of war, a new era of prosperity dawned. The post-war period, spanning the late 1940s to the 1950s, was characterized by consistent GDP growth. This was the result of several factors, including a boom in consumer spending, increased housing construction, and the rise of new industries. Government initiatives like the GI Bill played a crucial role as well, providing veterans with benefits such as education and low-cost loans, thereby supporting the development of a robust middle class. This was an age of optimism and progress where the promise of the American dream seemed within reach for many. The U.S. was transforming from a war-torn nation into a land of opportunity, marking its position as a global economic powerhouse. The post-war period wasn't just about economic recovery, it was about laying a strong foundation for the future, one that could withstand the challenges and changes that lay ahead. This era shaped the economic, social, and political landscape of the U.S., setting the groundwork for the prosperity and growth that was to come. The post-war period shaped the U.S. into an economic powerhouse, setting the groundwork for future prosperity. The latter half of the 20th century was marked by continued economic growth and significant technological advancements. As we transitioned into the 1960s, the economic landscape of America was experiencing an unprecedented acceleration. The GDP growth rates were peaking, presenting a period of prosperity that would lay the groundwork for future economic developments. The 1960s were a time of vibrant change and innovation, with the economy growing at a robust pace unseen in previous decades. This era was not just about economic growth, however, it was also about the transformative power of technology that began reshaping industries and the way we live our lives. As the decades rolled on, the 1980s ushered in a new economic philosophy. Reaganomics, named after then-President Ronald Reagan, came to the fore. This approach emphasized tax cuts, deregulation, and a reduction in government spending. The intent was to stimulate economic growth and investment, and it certainly had a profound impact on the American economy, shaping its trajectory throughout the decade. Meanwhile, another revolution was brewing, one that would change the world as we knew it. The 1990s saw the rise of the internet, a development that would fundamentally transform our economy. The internet's advent opened up a world of possibilities, enabling new business models, enhancing productivity, and connecting the globe like never before. This digital revolution, coupled with the ongoing process of globalization, brought about a new era of economic prosperity. But these advancements were not without their challenges. The rapid pace of change brought about by the technological revolution led to shifts in the job market, and globalization had its own set of complexities. Yet, these developments were pivotal to the economic narrative of the United States, shaping the country's economy in profound ways. The technological revolution and globalization set the stage for the economic challenges and recoveries of the 21st century. They demonstrated the capacity of the United States to adapt, innovate, and overcome, providing a foundation for the economic journey that lay ahead. The 21st century has been marked by periods of economic volatility, including the dot-com bubble burst and the 2008 financial crisis. As we step into the new millennium, the United States economy faced a significant setback with the bursting of the dot-com bubble. This was a time of market speculation where internet-based companies were overvalued, leading to a stock market crash. Following this, in 2008, the economy took another hit with the financial crisis, one of the worst economic downturns since the Great Depression. This crisis was a result of a burst in the housing market bubble and led to a severe global recession. However, we see the U.S. economy's resilience as it bounced back from these crises. Steady growth was seen in the 2010s up until the COVID-19 pandemic hit in 2020, causing a significant contraction. Despite these challenges, the U.S. economy has demonstrated resilience, paving the way for future growth. The recent economic trends in the U.S. reflect a robust recovery following the COVID-19 pandemic. After a significant contraction in 2020, the American economy made an impressive comeback. The gross domestic product growth rate for 2021 was an astounding 5.95%. This rebound was a shining example of the resilience and adaptability that has characterized the U.S. economy throughout its history. As of the most recent data, the U.S. holds a commanding position on the global economic stage, with a GDP of approximately $25.463 trillion. Furthermore, the GDP per capita figure stands at about $75,269. This is a clear indication of the economic strength and prosperity of the nation. The U.S. economy's journey from its humble beginnings to its current status as a global economic powerhouse is a testament to its resilience and innovation.